Hi, welcome to another edition of Nucleus Investment Insights. We are on today talking about the ripple effect of Chinese overinvestment. The main thing I really wanted to talk about was going through this idea that there's, and in Australia, I think we obviously see it a fair bit now. New EV models coming out from China every second week, and there's a lot going on the investment side in terms of cars, and I just thought it was well worth talking through some of the big picture maths, where it's going, because it is affecting a whole bunch of other sectors as well, and just talking energy, oil prices, the price of car companies in developed markets, all these types of things are all having a huge impact, and it's just sort of well worth going through all those different issues. So just a reminder that everything you hear today is general advice. None of it is personal advice. You can follow the show notes if you do want to grab a meeting with somebody who can help you with that. But with that, we'll sort of no further ado, we'll just jump straight into it, and let's talk about the what's happening in terms of this and where we think this is going. So I'll. It's a little bit word heavy to start with, but I think the main thing to note is, look, this is not just an investment story. This is really about, and it's really not just about cars. It's about industrial strategies in all these different countries and geopolitical strategies. So car sectors tend to be hold a lot of sway with governments. So not as much in Australia anymore. But for years and years and years, there was always this car pressure in Australia about subsidies and what are the extra things you're going to get to try and keep domestic manufacturing. And then 20 odd years ago, Australia basically gave up on that. But that's still very much the case in Japan, in China, in the US, a lot of Europe as well. Has got all this idea that you need to keep this car manufacturing local, and so that really plays with the investment statistics in this sector, because if you're in a country that's not heavily supporting its car sector and you're competing with others that are heavily supporting the car sector, then that can make a difference. And then the other thing though is there's all these other sectors that sort of flow off that. So the fact that cars are being subsidised in one country might mean differences for, say, the energy sector or oil and gas or all these other things within other countries. So it's quite a far-reaching effect upon what it is. And so I think the best analogy is really talking through what happened in the solar panels in China. So 20 odd years ago, China basically made the decision that they wanted to be the world leader in solar panels and put a lot of state subsidies into it. And effectively what ended up happening was solar panel manufacturers around the rest of the world basically went broke. So they poured so much into it, produced it at loss-making levels, and then built up the amount that they were doing to vast quantities, and then got all these extra economies of scale, and then that meant that suppliers in other countries without that same sort of scale couldn't compete, and that sort of led to effectively the extinction of that solar panel manufacturing elsewhere. And so the question is, is there something similar happening in the car sector, and particularly in electric vehicles? And the answer is yes. They're doing lots of in terms of China. There's lots of extra subsidization of these cars, but there's lots of countries feel a lot more strongly about the car industry than what they did about their solar panel industry. And so the protections around that and sort of various competing agendas and industrial policies is really going to make a huge difference within this sector. So so that's one part. And then the next part is, what does that mean for pricing and profitability in particular in that sector? And generally speaking, when you have these big subsidies, it can be it's great if you've got the country that's doing the subsidizing, but then if it's an arms race and everyone's just sort of fighting this part, then it tends to be a bit of a race to the bottom. And I think there's certainly some other factors sort of coming through in the driving in the car sector in terms of it being anyway. Let me get into that sort of other changes in that sector, which mean that it's probably worse for pricing than it's been for some time in terms of margins, and so effectively just car companies pushing those margins down. Oh, sorry, consumers pushing those margins down, and car companies are really competing for those that extra capacity. So, I think we need to sort of keep in mind that, when China's doing this, and other countries are doing this as well, it's not about profit. It's not out there trying to sort of, looking at companies and saying, how can we get the most amount of value for these car companies? Mostly it's about employment for a lot of them. And this is sort of, I guess, a remnant of when manufacturing was much, much larger and the unions were much, much stronger. But the idea is that, there's a in a lot of politicians' minds, there's this idea of these manufacturers and these manufacturing lines, and this is the blue collar America or blue collar Europe that needs to be supported, and that the car industry sort of is thought of as one of the leaders in that, and one of the biggest ones there, and it might not be as true as it once was. So, within governments, the idea is it's about this industrial leadership part then as well, and defense as well. So there's this within all these countries, there's usually this part about saying, well, we know we need vehicles of some description if we need to go to war. If we have no factories producing these things, if we're getting them all from offshore, and we do happen to go to war, then all of a sudden our country is a massive disadvantage. So it's much easier to convert say a car factory across to be making tanks or vehicles that can be used in combat than what it is to try and build these from scratch if you end up in a war. So that part of it is that part of it's part of the reason why you've got this backing. Then within China as well, there's the way the incentive systems work. It tends to reward local officials for GDP growth is a very common one. So effectively, what they've there's this real focus on saying, well, if I can get a car company to move to my province, and I give them all this cheap land and tax cuts and all that type of stuff like that, and then they go out and hire a bunch of people and make a bunch of sales and particularly export sales and all that. Even if they're selling these things at a loss, well, GDP doesn't care about losses. And in particular, the way China calculates its GDP even more so doesn't care about losses. So I'll explain that in a second. But the idea is that, as long as you're selling something, as long as you're employing people and selling these goods, that's adding to GDP. Even if it is sold at below the cost of what it was. So that's one factor. Then within the way China, and that's true of all countries in terms of how they'll calculate that GDP. But the difference in China is that the local officials are directly incentivized to increase GDP, which is not the case in most other countries. If you're in a Detroit in the US, yes, you want employment and you want manufacturing, you want wage growth and all this stuff like that, but you actually don't really care about what the technical effect is on GDP. Whereas, so if your car companies are loss making and potentially going to go broke, then you care about that for the losses of the jobs, but you don't really care about its. You'd prefer them to be profitable and be confident they're still going to be there, rather than trying to produce just for the sake of producing, which is more the incentive in China. And then secondly, within that, there's there's a part about write-downs. So within China, the GDP is very much set not to have write-downs. So whereas you build a factory, say in the US, and 2 years later you go broke, you're writing it down, and that's affecting GDP. Whereas that's not the case in. So that's sort of the broad picture within that. Then we have the introduction of electric vehicles, and China, more than a decade ago, sort of put in this industrial policy to really try and take leadership in this area. And the interesting thing with electric vehicles is that they are a lot easier to manufacture than internal combustion engines. And that's part of the reason for China really making a push in this area. A couple of decades ago, or a decade or more ago, was this idea that, well, it's actually very hard to break into an industry that's spent the last 50 to 100 years sort of developing this expertise and the engineering around it is, effectively, combustion engine is a controlled explosion sort of sitting in the middle of this, and the safety and you effectively have to build the car around the engine to make sure the whole thing works and fits together. Whereas electric vehicles are just not that same. They're very much componentized. While we do have a number of ones in China, taking right up and down the whole value chain in order to be able to produced at lower costs, the individual components within the cars are much more modular. And so, mobile phone manufacturers, effectively that are now out there sort of producing cars and setting up factories to do this, with the idea that, well, if we're putting together a mobile phone, which is quite complicated, we're not, a lot of these guys are not making any of the parts. They're just sort of taking these parts from others and assembling them and putting together phones. Is actually, that's the technology within that is not dissimilar to the technology to produce an electric vehicle. And so you've got that sort of added sort of technological benefit sort of coming through from that. So that sort of lowers, really lowered that barriers to entry. So we're sitting in China now with, hundreds of these car companies out there. There's sort of directive to try and consolidate and to try and get more scale. But there is a real price war going on within China. And then we overlay the tariffs in the US, so much harder for Chinese cars to go out to the US. And so now they're trying to flow out to other countries, and they've got all this excess capacity because they're all incentivized to produce as many cars as possible. You've got countries in Europe the US, let's use US as an example. They're like, well, we've got our own car manufacturing industry, and in particular, Elon is quite instrumental, obviously, and so still has at least some managed to get some things put in terms of the policy there, that the idea was that they want to protect their local car industry, and so really limiting what China can do and the tariffs. Europe's not completely dissimilar to that, so they're not as extreme, but they've got the same desire to try and keep their local industries and not to sort of find out in 10 years time that say the German car manufacturing or Eastern European car manufacturing, more like it, has sort of all been decimated and everything's coming from China now. So okay, so that's where we are in terms of the sort of the background to this. Then we sort of talk about where do we see, so we've got this technological change coming through, and then the question is about how fast are electric vehicles coming out. And I know there's a lot of nostalgia around various types of cars, and people have views about which cars are better and which ones aren't. And I'd never drive an EV because I worry about the range, and there's all these factors coming out about that. And I think how we take it is, there's certainly arguments you can have for not wanting to drive an electric vehicle at the moment and saying, no, it doesn't suit my needs or doesn't do whatever whatever you need it to do or right now. But a lot of this is just about trajectory. So it's the idea that, yes, electric vehicles, go back 10 years, were more expensive, a lot more expensive than ordinary cars. But they've been coming down quite dramatically. And some of that is just a scale in terms of, if you're producing 100,000 cars a year, then your costs are X. If you're going to turn that into 1 million cars, well, that X is going to come down by 30-40% just because of the scale benefits you're going to get. And now, electric vehicles are very much moving into that scale benefits. The cost of the battery is falling quite dramatically. The range you're getting out of batteries is increasing dramatically. The charging power is increasing dramatically. There's arguments around all this about why. I don't think electric cars are right. For me or for the whole society right now as a solution. But if you just follow the trajectory of all these lines, it's the battery cost will come down. It's already you'll have cheaper running costs. The energy costs is an important factor within that. We'll move on to that in a minute. But it's it would seem pretty clear that there's lots of things sort of pushing in this direction in terms of electric vehicle taking up over time. And then the question, there's a question about how fast and all that sort of stuff like that. But we'll move on to that in a sec. What I might do is jump to a quick slide. So this is just showing the number of cars sold. And the 2025 is sort of partly actual, but mostly some estimates around sort of orders and stuff like that. But and so keeping in mind, ballpark, we're talking about passenger car sales of about 100 million a year for the globe. And so we're talking about over 20% now from a global perspective. Much lower in some countries like Australia. higher in others. So, a lot of Europe is sort of around that sort of maybe 25, sorry, is around that 30% levels. And sort of, country by country depends upon subsidies and charging infrastructure is a big one. And just the dynamic of the country. It's, some countries that, quite condensed and people don't drive very far and most of the driving, say, is done around London, and very rarely travel long distances is much more, suitable for electric vehicles, whereas, bigger countries, with a lot more sort of, average transport is, leads to lower sales within that. And so particularly the US is, the level's quite low and going and forecasts are falling, quite significantly for US EV sales, just around, Trump has obviously, well, maybe for anyone not paying attention, Trump is certainly rolled back most of the incentives and, is very much, supporting more about the oil industry. And so, I think there's, the rollout within the US is going to be a lot less than what we're seeing in other countries. Okay. So that's our sort of baseline for saying but we've got quite extraordinary growth, even just over the last 4 years, we've, sort of, basically quadrupled the number of cars that are being sold and market shares just sort of picking up year after year. So that's one part of it. The next part then is, I wanted to discuss then is, this idea that, the lithium demand as well is sort of, going up dramatically. And so that's a big one for the Aussie market. There's a lot of lithium players within the Aussie market. And just noting that, this isn't lithium within lithium. It's not, your cars aren't the only thing. They're one of the biggest things, but we've also got this stationary storage that's really starting to pick up as well. And there's other battery chemistries out there, competing and there's lots of other factors as well. But, you're seeing this rapid increase in terms of demand for these batteries coming from all these different places. Now, within that, that whole lithium sector is worth noting that it's a really tough one. Like just because the lithium sector is growing at these rapid rates doesn't necessarily mean the price is rising. And we've seen that over the last couple of years. Well, we've been through a few cycles. And the tough thing with the lithium market is, if demand is growing at say 30% in this market, and supply grows at 20%, then, or not even, let me go to sort of closer numbers. Demand grows at 30%, supply is growing at 26 or 27%. Then prices start to shoot up because there's all this demand. There's not enough supply. The prices for these there's this mismatch, and we're talking about some big changes. You just millions of tons that are left over, and so they have to shoot up. And then you go the other way though is okay, well, demand, supply still stays at whatever 26 or 27%, but demand's only 25% rather than 30%. Okay, now we're seeing falling prices for lithium. And so, and there's this real pipeline of increases of in terms of lithium demand. And so, I guess the what I want to highlight within that is, you're in this growth sector, but just because you're there, it really is within commodities is just keeping a real close eye on that that demand line, the supply line as well as the demand line. Okay, so we're facing these rapid increases. Then the next part then is really talking about the cost in terms of petrol or gasoline to run these cars, because there's sort of been an interesting factor over the last 4 or 5 years. I've got a chart up which is just showing the changes from it's a Bloomberg chart, just showing the changes in costs if you're comparing residential electricity to gasoline. And so the line they've chosen, which is completely arbitrary, but it's I think it's worth noting, is that if you look at the number of EVs where your residential electricity cost is less than half of the gasoline cost. So within Europe, if you went back 4 years or 3 years, sorry, to 2022, you're actually I think they've mislabeled the chart. Sorry, they've back to 2020. Sorry, 5 years. Then you get that it was well over 50%. So most countries in Europe, you're getting your fuel costs at half the costs. That's fallen now to more like 25%. And so with a mixture of falling gas, rising electricity prices, falling gas prices, and a bunch of subsidies around the whole Ukraine war and all these things like that. But it's Europe certainly changed in terms of that factor. The rest of the globe still looks pretty good, though. You're still looking, 75% of the rest of the globe, where by switching your fueling cost is less than half. And so, and I've spoken in the past about how a lot of this is really just about coming back to what you're prepared to take in terms of the big extra cost is the battery cost. And so if you were prepared to have a battery that only had a 100 kilometer range, because all you ever drove was 50 kilometers a day, and it was, say it's a commercial vehicle, say it's a postal van, and drives 50 to 60k a day, comes back to the depot every night. You've got enough electricity to charge it. Great, you can have a 100k battery, no problems at all. It's well, the battery is now much smaller. It's well into the economics. The economics look great at this point. But if you're no, I might want to drive this 500 kilometers every now and again, I need a battery 5 times bigger. Well, now all of a sudden the battery cost is 5 times higher. And so that's that part about, a lot of this really is about range, and that whole idea around where does that tap out? And so, you've got, I'll talk in a minute. Actually, let me get a quick sales message and then we'll come back and talk a little bit more about that.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yeah, so a lot of the argument really around now, in terms of it from an economic point of view, is if you can deal with shorter ranges, then electric vehicles are economic now. If you need the longer range, then you start to get to the point of, okay, now we need bigger batteries, and it starts to become less economic. And it's really a question about the relative pricing between oil and electricity at that point, and where does that sit? Now, I do want to sort of overlay a big thing over the top of this is people don't buy cars for economics. If that was the case, BMWs and Mercedes and all these other cars wouldn't sell anywhere near as many cars as what they do. There is absolutely a large part of the car market which is not sold on get me the cheapest thing or get me from A to B in a minimum standard of comfort. It's more about I'm signaling my status or signaling wealth or whatever it is. There's lots of other factors that go into the whole car market that's well worth noting over this. But I think the flip to the big flip to electric vehicles really will base around that whole, okay, I was going to buy a BMW anyway. Now do I buy the electric version or the non-electric version? Okay, if I'm what's the relative pros and cons between that? So yes. So there's that part, but I also want to talk around this, because we're really talking about these trajectories and about where we're seeing these costs go. So the cost of the batteries keeps falling year after year after year, and that's coming down at quite significant rates. And the way I think about it is, if you're if you're driving sort of maybe 50,000 kilometers a year, then the economics definitely fit in your part to switch to electric vehicles. If you're already driving 8 or 10,000 kilometers a year, then they definitely don't. And then between that range, then now you're talking about, okay, what are all the different subsidies on order? What's the relative cost between energy for electric vehicles and and oil within various countries and all the subsidies and all these other factors that go into it. But it's sort of, to me, it's relatively clear at the lower end, there's not an economic argument. Towards the upper end, there is definitely an economic argument, over 50,000 kilometers a year. And then as you sort of drift into that range, that just kept coming down year after year after year. And for some countries, that level's now closer to 25,000. For other ones, it's still close to 50, just based on the relative cost of these different fuel types. So then you get back to the part about, okay, if you flip the entire electric vehicles if you flipped all vehicles across to electric vehicles, what does that actually mean in terms of the can we handle that costs in? Can we handle the amount of electricity that's needed? And so if you sort of do there's these big charts, and I've got a chart up just sort of showing that the amount of energy consumption in the US and measured in quads, which is sort of just trying to bring the numbers back down to something more reasonable. And you sort of look at this and you go, well, there's about 37 quads worth of electricity generation. And then if you're producing that much electricity and how much you need for transport, well, you need about 28 quads for transport. And so you're talking about, 2/3 of all electricity would be needed to sort of electrify, say, the US fleet as an example. But that's sort of looks like the sort of broad-based one, but that's all false. Like it's not accounting for all the different things that go into this. And this is where I'm sort of calling this fighting physics, because if you look at I've got just for anyone listening in, I've got a picture up just of a car showing all the energy losses. So the engine losses are somewhere. So you start with this energy in your fuel, and then you're going to lose around about 70% from your engine in terms of the power. And that's the thermal, exhaust heat, combustion, pumping, friction, all this type of stuff like that goes into it. Then you can add another sort of 1 or 2% from all your different climate control and seat warmers and headlights and steering wheel, electric steering wheels and all that type of stuff like that. There's a bunch of different water losses, another sort of 5%-ish losses from your different pumps of oil pumps and water and fuel pumps and ignition systems and engine control and all that type of stuff like that. Then you get this what you call energy to wheels sort of losses, and what this is sort of your wind resistance, your rolling resistance, your braking, and there's about another 20% you're losing from that. Your drivetrain loses another 3 to 5%, and then you got another part of sort of idling losses, and so you basically end up with what the amount of energy that sits within oil, most of it's dissipated before it gets to the car. So there really are these massive energy losses. So electric vehicles, they get around a lot of that. So a lot of them are similar. So say your energy to wheels is sort of similar, but your braking gets captured again. So they've all got the regenerative braking within it. Your idling losses are pretty close to zero. You get, because you've got that regenerative braking, that actually gets you more power back into the battery. You don't have all those heat losses that you have. You do lose within charging, so say 10%-ish energy sort of lost in the whole charging process and the back and forth. But the number of losses you get from all those figures are significantly different to the combustion engine cars. And so what does that mean in total? Well, it means you're about 3 to 5 times more electric vehicles for the same amount of energy. So each year you're burning, say, call it 22 quads worth of oil for motor engines. This is sort of broad figures in the US. And that gets you sort of 4 quads worth of mechanical energy. So you've got to burn all this energy, lose it all, and you're only getting 4 out of that to actually, the actual mechanical getting you places. And then you look at that for an electric vehicle instead. So to get sort of 4 quads of motion for an electric vehicle, you only need 7 quads of electricity sort of going in. So within this, you're sort of fighting physics for it. So short term, obviously there's all these costs getting across, but longer term, the numbers are very hard to get around. And we've had whatever it is, 100 years of trying to make combustion engines as efficient as possible, there's probably not heaps of major increases that we're going to see there, whereas electric vehicles are still sort of relatively in infancy and still picking up in terms of these gains. And so the other thing then is saying, well, okay, so what does that mean for we've sort of taking some broad figures for what it, for those numbers, and then it's about saying, well, if we come back and say, well, what does that mean for the US if we actually wanted to flip the entire fleet across? So the US sells about 17 million vehicles a year, and there's about 290 odd cars registered in the US. So you're talking about 17 years to convert the entire thing. Now keep in mind, this is heroic. This is basically saying next year, we slap something on and you can't sell another combustion engine car ever. So you've got 17 years to convert everything across to electric. And so realistically, we're probably double that or at least some significantly more time. And then you sort of go through how many kilowatts per 100 kilometers does an electric vehicle use? What's the average US driver to drive? I'm just going to put it back on the houses and just say, look, let's say most of the charging is done at home, just because I just want to see what the how much extra charging you need at people's houses. Maybe that number's lower, but that'd actually help improve the situation. And then you sort of go 1.9 cars and drivers per household. So you're like, right, okay, so households are going to need another 5,500 kilowatts of power per year. At the moment, they use about 10,000 kilowatts per power. So you're going to need about 50% more electricity to the household sector over the next 17 years, which is about 3% annual increase. So if we're taking twice as long as that, then we're talking 1.5% annual increase in electricity to the household sector. So it's not terrible. Like, it's not a it's certainly it's not sort of immediately doable. Obviously, there's going to need lots more investment in this sector. Maybe it just means that lots of we're putting more solar and batteries actually might drive a fair chunk of that. But it's a calculation that certainly is not horrendously scary. The problem with that is data centers, and that's sort of this next part, is the AI side to this. So if we look at, I'll pop up another chart of what's happening in data centers, and the whole range of different things. I'm going to use a lot of the IEA, which usually have quite good assumptions within these. I'm just sort of showing this chart of all these different versions of assumptions about they can't even agree how much data center electricity is being used at the moment, I suppose. And I've got semi-analysis, which is relatively reputable as well, but they're significantly above IEA. And just sort of just so you can see the relative changes, is you're probably talking about between the IEA base and the top is a little bit more than double over most of these periods. So we'll just sort of keep that in mind, that the IEA is pretty similar to a lot of other ones, but maybe the numbers might be significantly higher. And so I think the key part to this, though, when you start digging into this, is that, okay, demand is increasing dramatically, but demand is actually not very big at the moment. So we're talking about 1% of global electricity consumption at the moment. So doubling, tripling, quadrupling, and this is all happening really quickly as well, is an issue, and definitely in local areas there's issues and all that type of stuff like that. But because it's such a small sector to start with, okay, so we need to double it over the next year. Okay, we need 1% more electricity to sort that out. Then you go, okay, how about electric? We've got electric cars coming and other things like that. So there's IEA also sort of had a bit of a look and said over the next this was a 2024, it's a 2025 report, but the latest numbers were 2024. So they just looked at the growth in between 2024 and 2030 and said, well, look, what do data centers make up? And they're not actually even in the top 5. So, we've got these, what they're calling non-heavy industry, other make up much larger parts. The electric transports, that's the EVs part is there. And then, various appliances and cooling and heating and heavy industry sort of make up the rest of that. But we can see from here that data centers, even at their sort of peak, they're certainly an issue and another major source of demand. But there's lots of other demand sources coming out, and so I guess we're talking if we can be expanding the electricity network by sort of 2-3% per annum for the next sort of 5 or 6 years, that's sort of going to cover most of these demands. And so it's not sort of the numbers might sound scary when you say, we need double the amount of electricity used for the data centers, but because it's such a small part, we're not talking about doubling the entire electricity network. So yes, so that then does flow back into the investment scheme, though, investment thoughts for that whole sector. So what do you invest in here? So there's obviously a longer life for a lot of the fossil fuels that you might have otherwise, excluding the electric vehicle transport and excluding the data centers, you would have had the thought they were fading away a lot faster in terms of the demand. And so, and sorry, when I was talking about fossil fuels, I'm talking about fossil fuels that go into the electricity network, which very much tends not to be gas-based anymore. So, 20 years ago, absolutely. Actually, a lot of the Middle East would fund it, would power its electricity networks through oil, but the relative price of oil versus coal or gas changed, so that really just doesn't get done anymore. So, yes. So that whole sector, you can have an argument about how long that holds up. Again, these are commodity players, so you do have these big cycles where they'll go through rapid increases and decreases. We did see this massive spike in prices as everyone tried to cut Russian oil and Russian gas out of their networks. There's not a lot left in that. Could you lose somebody else from it? Yeah, maybe there's some arguments around things happening in the Middle East and losing a lot out from that. But again, that's not a it's a risk case out there, but it's not a base case. I think that a lot of the danger a lot of the issues around that whole switch of Russian gas have largely been dealt with, and Europe is largely not using Russian gas and looking at trying to reduce the oil dependency at the moment. So where we've been playing that is still in this transition phase. It's the trying to find the companies that are involved in less in the technologies about where you're going and more in the service providers to this, because we everywhere we look, you just keep seeing this. There's more change. There's more reason to keep changing this electric network, and whether it's even if you decided that actually the politician's going to flip back to more of a Trumpian view, and that it's going to be more about trying to stop wind and stop solar and really allow these other and put it more back to coal and things like that. Somebody still needs to go out and build these new factories. Somebody still needs to get out and plug these into the existing networks and the transmission and all these other factors. So our view is that, look, the economics are winning out for solar. The economics are winning out for batteries. The economics are winning out for wind. You might get shifts back, say for Trump, shifting you back away from renewables, but the economics are still improving and just keep getting better year after year. That's a temporary thing, and we've actually been using some of these. There's been some good opportunities we've seen as sort of some of the better companies are falling in price in order to jump in. So Vestas Wind Energy was one we sort of picked up a lot of last year. Wärtsilä's another one. There's just a few of these companies that are involved in that sector where we just see that the longer term economics are very much in their favour. You can have some big run-ups in price when everyone gets excited about these things, and that's the time to clear out of them. And then you can get some falls in price when everyone's worried that Trump's going to kill wind power forever. And the idea is, well, no, actually the economics still stack up really, really well. Even states like Texas are hugely investing in wind power, even with removing a lot of the subsidies and Trump's sort of general negativity towards that sector. Is that there's the economics just stack up too well. Okay, so that's how we sit for the energy sector. So yeah, for us is very much about trying to get the exposure to the players that are servicing this sector, and just because regardless of how you see it, there's change happening. And those guys, look, some of them are a bit expensive, but they're not terribly expensive. So, yep. And let's go to a quick sales message, and then I'll jump onto the next investment side.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. Sorry, one more graph actually before I jump to that next one. And what I wanted to just touch on is while what I was saying is true at the aggregate level, it's worth noting that it's at individual country levels and at individual country levels and particularly within regions, this electricity demand from data centers is not evenly distributed. So if you look at the growth that's expected, and let's take Japan as they're right at the top of this table. So about half the electricity growth in Japan is expected to be from data centers. Now, we need to overlay that with the fact that Japan has a shrinking population. They are very big industrially, but they have been, over time, Japan is a high wage country, and they have been outsourcing more of it offshore, I guess, in terms of the physical processing. And so, its growth it's not the same type of growth you see elsewhere. Whereas if you look at China, where you sort of 90%, 93% of demand growth is outside of is not coming from data centers, and 7% is coming from data centers. Well, yeah, China's still, and they do have a declining population, but they're still spending lots of money in terms of capex and trying to build more factories and other things going on. And a lot of developing countries, have got much higher population growths. And so, so broadly for advanced economies, you're probably talking about a quarter of your demand. A quarter of the increase in electricity demand is going to be coming from data centers. And then most of that, or a big chunk of that next one, is going to be then coming from that switch to electric vehicles. Yeah. Right. So there was that one. The other one, though, I wanted to then talk about, which is sort of slightly off topic, but it's worth noting, is the whole agricultural sector. So one of the biggest users of ethanol is the Brazilian transport sector, and a lot of cars within Brazil can use either petrol or ethanol. Now, there's investment issues within that sector, but look, it's not that big of a sector, so I'll probably avoid that. But it's interesting for the thoughts around the agricultural sector. And so I've just got a chart up, again from Bloomberg, which is sort of showing that, as at 2025, we're talking about a few percent of ethanol displaced by EVs, but they're expecting, over the next, that's going to hockey stick over the next little while. And this is going to be this, significant take up of ethanol. And look, there's a reasonable argument that that might even be a little bit slow. The growth they've got there. So if that's the case, though, it does, and it's expressly stark in Brazil, but it is also the case in plenty of other countries where you have that biofuels, is that if we start going down the path where biofuels are one of the ones that starts getting phased out more early, so as fewer people use it, is start saying, well, let's actually start converting those biofuels across to other products. That might be a thought around the whole the whole cost of agricultural products. So there's this, effectively you've got a bit of a crowding out. If I have a field and I'm growing crops for biofuel, and now I don't need to grow for biofuel, all the economics don't add up the way they used to. is, well, I'll flip that back and I'll now start selling something that I can sell for, you know, livestock to eat, or sell it to for people to eat. And so that's sort of this idea around, well, how much of the inflation have we seen in in food prices has been this sort of competing between, you know, we're turning what is otherwise, you know, quite good food growing areas into growing crops in order to fund our transport habits. And so early stages, but certainly worth sort of considering that whole sector. That, look, there's you know, there's potentially room for price, some of the price pressures to fall within that sector. So that was those. Then we want to talk about the there's obviously tariffs. I'll probably skip over this relatively quickly. I mean, you know, I spoke a little bit more about it. That very much governments do think about car industries as being a security issue, as well as employment, and just a number of jobs. You know, we had the most senior advisor, certainly one of the most visible senior advisors of Trump right at the start of his presidency was Elon Musk. And so, you know, obviously car companies still have an outsized sway in terms of politics and getting subsidies. And, you know, last time when we saw the financial crisis, there was bailouts for all the major car companies coming from Obama. You know, there's a strong history, not just in the US, in plenty of countries around the world, of really supporting those car industries. And so that's that. That's the hard part about investing in any of that sector now, is that if, you know, you're buying Toyota, for example, because you like the look of it, but now the question is, well, what's the relative position of how much is Japan going to support its car sector versus how much the US is supporting versus Europe versus China, and you know, there's this whole relative tariff argument about, and that stuff can change, you know, pretty close to overnight, as we've seen from Trump. You know, it does change overnight from the US perspective on an ongoing basis. So I think there's your buying within that sector is just fraught with risks you don't see elsewhere. And that's why what we see within that whole car industry sector is that the valuations are really low relative to the rest of it. If you're looking for value stocks, absolutely, you know, most of the major car companies trade on single digits in terms of price to earnings ratios. So you know, the market's on sort of 20, 22 times. You can pick up most car manufacturers in developed markets at, you know, 8 times or less. Some of the car companies that don't sort of sit in that same bucket is interesting in that they tend to be the luxury car makers. So Ferrari or Porsche, they're probably more like 15, 16 times. And it's this idea about, well, actually, are these guys really, you know, they're not producing mass market cars. Like they're not talking about this whole cost issues around for them. You know, yeah, okay, they want to keep their costs low, but realistically, it doesn't cost $300,000 to make a Ferrari. You know, there's artificial scarcity, and it's all about the branding and keeping the scarcity in order to keep the value high, and, you know, all these other factors go into it. So there's priced more like a luxury good product, and you know, there's a you know, I think that's the argument for why these companies, why those companies are looked at more valuably than others, is that you know, that you're in one side, you're if you're selling Toyotas, for example, is you're a commodity good, or a close to commodity good, and you're competing with all these other people who are all trying to play in the same space. Can I give you, you know, a something that drives places for a low cost, and a certain level of quality. And so, whereas, that's sort of a different story if you're trying to invest in that luxury sector. So there's that part in terms of valuations. The other part then is all of the component parts that go into that. There's a whole infrastructure of people that fit around this. Now, the car sector used to be, go back 25 years, in developed markets, it was sort of 10% of the market was in that car sector. Now, and especially if you exclude Tesla, it's less than 1%. So, you know, it's fallen sort of 90-ish% in terms of the size of that sector relative to the rest of the market. And that's just an area for us. It's not an area we've wanted to play in. You're playing that whole risk around relative tariffs. You've also got the specter of driverless cars. So we have Google now sort of doing 250,000 trips a week with driverless taxis, and the issue is, as soon as you go to a driverless taxi, who cares what the brand is? Like, you no longer have the part about, well, I'll buy a Toyota because it's more reliable than pick XYZ Chinese brand in here, and so they can get a premium and things like that, because the person riding in the car is like, I'm going to be in this thing for 5 minutes. I don't care. Most cars are not going to break down in the next 5 minutes, and as long as I get where I'm going, the breaking down's the operator's problem, not my problem. And so so a lot of that brand stuff goes away, and then that whole idea about, well, if we're selling 100 million cars a year across the world, and most people aren't driving them, they're leaving them parked in their driveway most of the time, is that if there is a switch to driverless cars, and we see that, say, even if you said 20% of the 20% of the driving stops being done by your own car and starts getting done by these driverless taxis, well, there's a lot of cars behind that, because you run through your 100 million cars in a year, is that 20% of the driving might be done by, that might be 50% of the cars, because a lot of people have these second cars or even first cars that just don't drive very much, and then there's a lot of people who drive all the time. And so if you assume that the people who are going to start cutting them out is people like, well, I don't need that third car, or I don't need that second car, and so you could quite easily see the number of cars drop, like, precipitously in terms of the number of cars produced. Easily halve. If that's if that sort of picks up, and it looks like it's there gathering pace. We've spoken about it a few times in other ones, but I certainly highlight that that's an area. If you are interested in buying into this car sector, have a very close eye on what's happening with Waymo in particular, and Amazon's launching some things at the moment that look interesting as well. But could just decimate this entire sector. Right. Battery costs. I think I spoke a little bit about battery costs before. Probably I might leave that. But I guess the big picture idea there is that structurally, it's this idea of fighting physics again. That as long as the battery costs keep falling, and there's no signs that they're not going to keep falling, that at some point you're looking at saying, well, an electric vehicle is easier to produce than a combustion engine one. And if the battery cost falls, then eventually it will be cheaper you'll have a choice between saying, do I want to buy, even if you're buying the same brand, or do I want to buy the XYZ version of this car that's combustion engine and cost me 50 grand, or do I want to buy the battery version that used to cost 60, but now it's costing 45 or something like that. And so when it costs 60, you're like, okay, the question is, do I want to pay extra for this, and then I save myself a few $1,000s a year in petrol? But when it's like, well, the upfront cost is cheaper and the running costs are cheaper, I think that's depends really on the battery size, but we're not that far away. Within the next 5-10 years, be based on how fast they've been falling over recent times. So from an investment perspective, where does that leave us? It leaves us sort of Western car makers are really stuck between this sort of legacy combustion engine businesses and the EV transition. You're getting Chinese cars entering. There's tariffs. There's protections all flying around. Lots of political battles. Consumers are probably going to win out. Well, in some countries anyway. So as long as the tariffs don't go too high, but if it's if you're a country, say like Australia or a lot of the other developing world that doesn't have its own car industry to protect, then you're looking at cheaper cars. It's not just about that cars. It is this whole industrial strategy that's rolling out. And so for us, this is just a sector that it's by default you really want to be trying to avoid, and trying to get maybe some of the service providers if you are interested. But you need to have a service provider that you're relatively confident is going to be is going to stand up to the changes that are going on within that sector. And then just keeping remembering that, the car sector is, overall it's sort of 4 times smaller than what it was, and probably eight or 10 times smaller if you exclude Tesla. And there's pricing within that sector is is priced as if they're dirt cheap, and there's this great value within it. But there's enough uncertainty, I think, that's worth avoiding for the moment. Anyway, thanks everyone for listening in. Just a reminder, you can get us 12:30 on Thursdays. We are available on all the major and minor podcast platforms. Feel free to drop in any questions if you've got anything along the way. If you want to register on our site, nucleuswealth.com/content. And if you've got any thoughts or suggestions for shows, then pop a comment in on YouTube or pop us an email. Thanks everyone for listening, and we'll speak again next week.